In today's video, we are going to do a complete analysis of the NPS data to find out which is the best performing fund manager under the NPS. Yes friends, when it comes to choosing the best NPS fund manager, you should always look at few key factors. First, check the AUM, assets under management. It tells you how big and stable the fund is and how much trust investors have placed in it. Next, look at return consistency, especially over 5 to 10 years and since inception. This shows how steadily the fund has performed over time. Then, consider the experience of the fund manager, how long they've been managing money and how many market highs and lows they have gone through. Finally, look at the subscriber base. A larger subscriber base means more people trust that fund, and that says a lot about its credibility. Hello, and welcome to the channel, govt. Let's have deep analysis now. If you like the information, please subscribe the channel. As of September 30, 2025, the total number of NPS subscribers stands at over 2 crore across various sectors, with AUM of over 15,30,000 crores. As you know, NPS is a long-term retirement and market-linked product, which means that the performance of your fund manager makes a big difference to your final retirement corpus. As on date, there are 10 pension fund managers in NPS Tier 1, and they are HDFC, SBI, ICICI Prudential, LIC, UTI, Kotak, Aditya Birla, Axis, DSP and Tata. Some of the highlighted fund managers are relatively new, and therefore, their performance history over longer periods is still building up. Among all NPS fund managers, SBI Pension Fund is the oldest and most experienced player, while DSP Pension Fund is the newest entrant in the space. Each fund manager offers 4 investment schemes: equity, corporate bonds, government bonds, and alternative investment fund. Let's understand this. Scheme E: Equity Funds. Equity funds invest in the top 200 NSE and BSE companies, as well as ETFs, IPOs, and derivatives. They are designed for long-term growth, but come with higher volatility. Scheme C: Corporate Debt Funds. These funds invest in high-quality corporate bonds, term deposits, REITs, and INVITs. They offer moderate risk and steady income. Scheme G: Government Bond Funds. These schemes primarily invest in government securities and gilt funds, making them relatively safe and stable. And finally, alternative investment funds. These invest in infrastructure investment trusts, real estate investment trusts, mortgage-backed securities, and other alternative assets approved by PFRDA. This category was introduced in 2016. If we discuss average return, for Scheme E, it is around 14%, showing that equities have performed quite well over time. For Scheme C, it is about 9%, slightly better than most corporate bond mutual funds. For Scheme G, it is around 8.5%, which is quite comparable to gilt mutual funds. Average return, since inception in alternative investment fund, is around 9%, and the one-year return has been very strong, which is about 17%. If you look at the subscriber base and AUM, you'll find that HDFC Pension Fund leads the way across almost all asset classes. It is followed by SBI Pension Fund in the second position and ICICI Pension Fund in the third. So, based on both AUM and subscriber strength, HDFC ranks first, SBI ranks second, and ICICI ranks third. Now, let's take a look at the performance of the pension fund managers to find out who stands out based on returns over the past few years. We'll understand this in simple language and see how each of them performed across the 4 major NPS asset classes. To start with, let's look at equity portfolio performance. This data includes 1-year, 3-year, 5-year, 7-year, 10-year, and, since inception, returns. Some fund managers stand out because their short-term performance looks impressive, but remember, they are relatively new, so their long-term data is not fully available yet. If we look at equity performance, DSP Pension Fund Manager has delivered the highest one-year return. However, since it's new, it also tends to be more volatile. The benchmark return for 1 year was 2.65%. Among older players, Kotak delivered 5.5%, while HDFC, ICICI, and Tata showed similar performance. Over 3 years, the benchmark return was 16.82%, and almost every fund manager performed close to this. Kotak again led with 18.29%, while SBI delivered the lowest at 14.64%. 5-year to 10-year returns are most meaningful, since equity investments should ideally be held for long-term. Short-term returns can fluctuate a lot. Over 5, 7, and 10 years, the benchmark returns were 19.76%, 15.84%, and 13.81%, respectively. Over 5 years, ICICI, Kotak, and UTI outperformed the benchmark. Over 7 years, HDFC, ICICI, and Kotak beat the benchmark again. And over 10 years, HDFC and Kotak were the clear frontrunners. So, when you review NPS data, focus mainly on 5-year to 10-year performance and returns since inception. One fund manager that has consistently underperformed is SBI Pension Fund Manager. It has rarely beaten the benchmark return. Among all, HDFC stands out as the most stable and consistent performer overall. It has maintained steady returns right from its inception, showing both reliability and strong fund management. ICICI, LIC, and UTI are also performing well. However, frequent switching is not advisable. If your portfolio already includes HDFC, LIC, UTI, or ICICI, it's perfectly fine to stay invested. Difference between the best and worst fund managers can range from 1% to 3% per year. It may sound small, but over 25 to 30 years, that difference can mean lakhs of rupees more in your retirement corpus. Now, let's talk about corporate bond funds, Scheme C. Generally, corporate and government bond schemes deliver around 8% to 9% returns. Looking at returns since inception, SBI tops the list, followed by ICICI, HDFC, and Kotak. If your portfolio includes SBI, ICICI, UTI, or HDFC, you are in good position. Kotak and LIC have also shown solid performance. Next, let's look at government bond funds, Scheme G. Over 5 years, the average return is 6.19%, and over 7 to 10 years, it averages about 8%. Here, LIC Pension Fund, traditionally a strong performer, gave the best returns, followed by SBI and HDFC. Lastly, a quick note on the Alternative Investment Fund. UTI has been the frontrunner in 1-year returns, delivering 20.65%, followed by Tata, which gave 21.69%. But remember, only 5% of your NPS can be invested in this category. Since Tata is relatively new, SBI clearly stands out as a promising and dependable player among fund managers, followed by HDFC. It's always important to choose your funds based on your risk appetite and long-term goals. Friends, there are 2 types of returns: trailing returns and rolling returns. Whatever returns we were discussing is trailing returns, which is published at NPS Trust website officially. We have not discussed anything about rolling returns, because calculation of rolling returns is difficult, and it is a lengthy process. Some analysts provide the rolling returns but not the base of calculation. So, it may be inaccurate, or they may publish to favor few pension fund managers over others. So as a common citizen, it's better to rely on the trailing returns, as it is authentic data and one can easily understand. Now we are good to discuss the allocation. So, when you are choosing your asset class mix, please remember, if you are young and have a long horizon, go higher on equity. If you are middle-aged or near retirement, focus more on corporate and government bonds. Don't expect too much returns. Depending on your mix, expect 8 to 11% returns over the long term. Final takeaways. So as final takeaways, you should always review your NPS fund manager once a year. Remember, you can change your NPS fund manager once every financial year and even choose different managers for different schemes. Don't speculate the returns. Always go ahead with proper analysis of data. Switch only if performance lags consistently. Do not be in hurry. Stay invested for long term. That's how NPS works best for you. Every decision you take should lead to a peaceful retirement tomorrow. You know, choosing the right fund is important, but equally important is setting up your nomination correctly. NPS nomination rules are different from regular bank accounts. You can nominate only certain immediate family members as per NPS guidelines. Important to note that if NPS subscriber gets married, the earlier nomination made before marriage automatically becomes invalid. A fresh nomination must be registered after marriage to ensure the rightful nominee is recognized. For the full video on NPS nomination rules and step-by-step guidance on how to change nominees, both online and offline, check the link in the description below. If you found this video useful, please like it, share with your friends or colleagues, and do subscribe for more practical investing insights. I'll be back soon. Until then, stay financially fit.